Hey everyone, as you probably know, myself, Brandon, and Tom are currently in the United States following the Berkshire Hathaway annual meeting, and in between the content that we're creating over there, I've got some scheduled content, and this is one of those videos. Today is going to be a clip from the Young Investors Podcast, episode 173, and in this clip we talk about answering a couple of questions from our audience, talking about share buybacks, whether they're good or bad, as well as a number of questions on capital allocation. So I hope you guys enjoy today's clip. And as I've mentioned, if you want to follow the content that we're creating while we're in the US, then make sure you are subscribed to all three of our YouTube channels, and you can follow me on Instagram if you want to see the day-to-day and behind-the-scenes stuff as well. But with that said, hope you guys enjoyed today's clip.
How can you explain the constant reduction in book value that we see at Apple in the last decade? How does this sit with the love Warren has... Wait, WF?
I don't know. Is it a typo?
I just saw that. How does that sit with the love WF?
Who's WF?
Did I copy paste that incorrectly?
I don't know. We'll just assume it's Warren Buffett, right? We'll assume it's Warren Buffett. Not that it matters really to the question.
No,
anyway. No. So the question's about the reduction in book value from Apple. And this kind of applies to a lot of companies. Especially over the last 5 years. A lot of companies have done what Apple has done, which has resulted in equity on their balance sheet or book value going down, which is aggressive share repurchases. So they're spending a lot of money, not only of the profits that the business is producing, but the cash that's on the balance sheet. And when a business uses cash, or this is probably a better way to think about it, when a business delivers more cash to shareholders than it produces, so it uses its profits, but also profits that are coming in, but also uses some of the cash on the balance sheet or takes on some liabilities, then equity goes down. And it's not necessarily a good or a bad thing, which is something that you've heard. If you read through some of Warren Buffett's letters and some of his interviews, his philosophy on book value has changed over time. He typically exclusively looked for companies that had consistently increasing book value. And that's generally what you want to look for. But that principle, I guess, made a lot more sense when share repurchases wasn't all the rage, which is what it is at the moment. The last decade in particular, instead of paying dividends, companies just do huge, ridiculous amounts of share repurchases. So then the question just comes, is it good or bad for the company? And that question really comes down to whether the shares are being bought back by the company below what those shares are worth. So less than the amount of cash that can be delivered to shareholders over time. So the way I like to think about it, I just like to think of when a company repurchases shares, and this isn't perfect, this is an approximate way to think about it, but think of it the same way as if you personally were buying more stock. Because if you think about it, when you personally buy more stock, let's say you own some Apple, but you want to buy some more, what happens? Well, the cash in your bank account goes down and your percentage ownership in the company goes up. So you own more of the stock and you have less cash. And pretty much the same thing happens to the company that repurchases their own stock. The cash in their bank account goes down. And if you owned the whole company, which is a way of thinking about it, which is kind of a weird thing to think about when we're talking about share repurchases, but if you owned the whole company, you can think of that cash on the balance sheet as yours in a way. Then cash goes down. And because there's less shares available, percentage ownership for you has gone up. So in that respect, you should think of it the same way as if you were personally buying the stock. Is the stock undervalued? So that's how you can make a determination. But the reason why book value goes down is because you're seeing you're only seeing the first part of the equation, which is that they're paying for the shares. So the cash is going down because they're buying the shares. You're not seeing the increase in value that has been gained from each share getting a little bit bigger. And that's something that comes over time in the same way that when you buy a share, of course you do get the share. And I guess technically you could think of that as book value, but you pay the share and then over time it delivers you cash flow. So that's kind of how that works.
The way I just sum it up is I call share repurchases like an invisible investment.
Yeah.
Yeah.
That's a good
which
way.
it definitely does help shareholders, but in terms of looking at financial statement, I mean, of course you can see share repurchases on financial statements, but it does look like it's, if you look at a 13F, you won't see it, but it is definitely helping you.
Yep.
Even though, it actually looks like you could be like, whoa, what the heck? Equity's gone down?
Yep.
That's bad.
Yeah.
But no, it is helping you out.
Yeah, and in particular, you want to look for companies where the management team, a new CEO comes in for just 3 years, and he changes the compensation plan to benefit himself, and then he does aggressive share repurchases. That's the best situation possible, and using debt. So that's what you want to look. You want to look out for that.
What was that guy's name we were talking about last week?
I don't know, Kevin Johnson. Yeah,
Kevin Johnson,
retired for the second time in a decade.
Yeah. Kev. On you, Kev. All right. Should we do...
Yeah, where do you want to go from here?
We'll just do this last one. Oh, actually, we'll do this one because that's...
Yeah, okay. Hey, guys, what actually happens to shareholders if a company they're invested in is delisted? Example, Bubba, delisting.
Yeah. I don't actually know specifically like what happens to... I know that the shares are just traded over the counter. But I don't actually know how that relates to like voting and doing that sort of stuff and share registries and that sort of thing. I actually just don't know. I would need to go in depth. But it's like it's not great if a company gets delisted. You can basically guarantee that stock price is going down. However, having said that, it's not the end of the world. Like you will still be able to buy and sell shares just over the counter. The issue might be is whether especially if you're international, is whether the broker that you bought the shares through is able to offer share trading, over the counter share trading.
Right.
Which might be a problem if, like, for us buying Barber shares in the States using a international brokerage account, we'd have to check that. Yeah. But yeah, it's not the best, but it's also not the worst. Yeah, is how I'd describe it. But I don't actually know the ins and outs. That's something I would need to do a lot of digging on. Yeah.
Yeah, I don't think I have anything kind of to add on that. It's one of those things I certainly don't understand how it works, and I think for me at least that's one element of why I've decided not to invest heavily in Alibaba, just because it's something that's complex and I'm not quite sure what would happen if that was the situation.
All right. Hi guys, love the show, the vibe, the energy, everything. Thank you.
Thank you.
Long-time fan from Spain. Cool. I want to go to Spain. You ever been to Spain?
No, that would be great.
Nah, that'd be so cool. I just feel like Spain's one of those places where you'd just be like a non-stop party.
Yeah.
I mean, that's probably not what Spain's like, but that's definitely the vibe I get from what I see through media. But anyway, of course, the question: where would you guys set the line for not continuing to average down in a company that you have huge convictions in?
That's a good question, actually. I think for me personally, I have a limit of about probably putting about 20% of my portfolio in a single business.
Fair.
So that's probably where I would draw the line. But with that said, if a stock, let's say, gets within my range and I build it up to 20% in my portfolio, if it falls another 50%, assuming the rest of the portfolio hasn't fallen that far, it will be a smaller percentage than 20%. So there will now be room.
Genius.
There's now more room to build it back up. So that's something to keep in mind. So like
that you look at like your in and your buy prices, and it's like, Hamish, you've invested $1 million, or 900,000 was used to buy Alibaba, and it represents 1% of your portfolio. That means I could buy more.
Yes, exactly right. Yeah, no, but so 20%, and I think I think for everyone this is going to be different. Depending on your conviction in the business and your experience investing, whatever it is. For some people, it might be, I don't know, 5, maybe 10% you're willing to put into an individual business. Or maybe it's nothing. Maybe you just invest in index funds. Or you're Warren Buffett and you put 70% into American Express because you're crazy. I don't know.
Mad fool.
So yeah, I think
it's just individual, isn't it?
I think it's individual. Yeah.
It's not one size fits all. But I probably agree with you that around 20% feels about fair.
Yeah.
Because, I mean, For me, I just think, look, I still, I feel like I'm getting a handle on investing, but I'm certainly no Warren Buffett. That's for damn sure. I could still be making a mistake. And if I have made a critical error, how much is that going to hurt me?
Yeah.
So I think if you're like, oh, I've got huge conviction, you might think that you've got this one nailed, it's in the bag. But I just feel like having that approach is almost at one point in your life a recipe for disaster at some point, because you've always got to imagine there could be something, even if you haven't thought about it yet, even if it doesn't even exist yet, there could be something that sinks your battleship. So
Yeah.
I feel like, a little bit of diversification
Yeah. Goes
for
a
me
long way.
is quite nice, and it makes you sleep better at night too.
Yeah. I mean, Buffett was kind of insane putting 70% in American Express, because I believe the reason why it got cheap for the first time was I believe there was fraud going on in the management team. So very, very risky, I guess. There was a lot of uncertainty, I guess is the right way to say, about the future of the business, based on the fact that there was corruption going on within the management team. I don't know if I would ever see that happen in a company and think, let's go all in on this stock. That's some conviction. But I don't think he had 70% in it for all that long, so it wasn't anything too crazy. But yeah, very interesting. I mean, Munger is heavily concentrated. I mean, what is he? Actually, I guess not as much, but he only has a handful of
he's
stocks.
got like 3 big bets, I think.
Yeah, 3 big bets, and then people like Nick Sleep I think he had like 80% of his portfolio in Amazon at one point, but that was just because it had increased. It wasn't necessarily because he put a lot of money into it in the first place. It just did insanely well. But yeah.
And I think that's something to remember, because there are so many investors out there now, like so many investors. The people that are at the very, very top, it might almost be a little bit of the best representation. I mean, because all the people that have just seen incredible returns, that have made just a boatload of money, have, of course, been people that have been highly concentrated and have picked winners. I mean, of course, that's the recipe to success. But on the same like page, the people on the exact opposite end of the spectrum are also the people that were not diversified and had very, very big bets, except they just bet on the wrong companies and they went completely bust. So there is, of course, you have to kind of remember that at the very top, all of these people will be like, no, diversification is stupid. Why would you do that?
Yeah.
Because of course, like, if you wanted to be the bet, like, how is Elon Musk the richest man in the world? Well, because he's made big bet after big bet after big bet.
Yeah.
And they've all, because he's at the top, they've just happened to, I mean, he's worked very hard and he's a very smart dude, but they've all been successful. He hasn't really had a major flop. So I think that's worth remembering there. The people that do collectively generally pretty well are diversified. The people at either end of the spectrum that either do really bad or really good make really concentrated bets.
Yeah, I mean, certainly, the richest people in the world, you can think of their bet in the same way as investors, really. They've spent their life and gone all in on one business. They just happen to be managing it, which obviously influences their success as well. But they're all going all in on an idea or whatever it is, or on a certain product. But yeah, I think that's certainly true, especially for watching people who have, because you're right, if you have a highly concentrated portfolio, of course there's going to be, especially over a shorter period of time, there's going to be people who have success with an element or a significant element of luck. So that's certainly gonna play a role, regardless of what your portfolio diversification is. That plays a role, but yeah, I think concentration, I guess, does add a significant amplifier to that, especially if it does really well. So
and I'm not a huge diversification person. Like, I'm not like, oh, let's own 100 stocks. Obviously, that's not me. I still think that you should have. Why would you put more money into the 10th best opportunity when you could just put more money into the best opportunity that you found? However, I'm not the kind of person that would be like 80% in one stock, I don't think. Yeah. just to clarify things. Like, I'm not just saying diversification, whatever.
Yeah, I think I would probably let a stock go to 80%, I think, personally.
Yeah.
So if I'd put 20% of my portfolio into something and it became 80% because it did so well over time, I think I would be hesitant to sell any of that great company unless I felt that the stock had become insanely overvalued. But yeah, but I guess, I don't know, because that hasn't happened yet. So we'll see what happens. But
We'll see.
I would like to think that I could just hold on to a great company. But I guess if it got to that percentage concentration, it would be difficult to justify leaving that much of your wealth up to one individual company. So
Yeah. It'd make me sweat.
yeah, I don't know if you'd be sleeping well at night.
Anyway,